Welcome back to Journey Hard Times and the Good Times. I am your host, Jay Taylor, and I'm really pleased to have with me once again John Williams. He is the author of Shadow Stats, and everybody that's listening to this should go to shadowstats.com and sign up for John's very reasonably priced newsletter, as I do. If you care at all about the truth with respect to economic numbers as opposed to the propaganda that you're given by the government, then John's newsletter is essential. And basically, what John is telling us that inflation numbers are bogus, employment numbers are bogus, and John goes back and looks at things in the past as they were, and using the same yardstick to measure inflation and to measure unemployment as was used in the past. And so it's a very, very valuable. But John has also been warning us about the likelihood, not I think the likelihood in his mind, the certainty of hyperinflation. John, I'm so glad that you could come back with us today, even though the stuff we have to talk about isn't all that pleasant.
Thank you so much for having me, Jay.
It's always good to talk to you, even though you are the bearer of bad news to a certain extent. We want to know the truth, and I think, as the good book says, the truth will set you free. So, John, what about Donald Trump? I mean, surprising to most people. He prevailed. What do you make of this man, and what do you think it's going to do to the? Is it going to make a difference in terms of our future economic situation?
Well, I think he definitely will, and I think that's very simply why he got elected. If you look at the underlying real economic activity, we never recovered from the economic collapse into 2009. The average person senses that. Main Street USA hasn't recovered. You can always follow Main Street USA people about their pocketbooks, and that's what they did in this election. Every time disposable income, this is since they've had consistent numbers on this since 1932 was their first election. Every election where real disposable income has been below 3%, the incumbent parties lost the White House. And we're looking at something around 2.6% coming into this election. So the pattern there continued. Mr. Trump picked up on the long-term unemployed. You hear all the great news. Are down to 4.6% unemployment right now, according to the government. But that dropped from 4.9% the month before. That was largely unemployed people disappearing from the labor force because they couldn't find jobs. It wasn't gaining employment. And that's been a case all along here. Happy economic times, unemployment rate drops. That's because people are getting jobs. That hasn't generally been happening. I still look at an estimate of about 23%. I'm a little bit below that now in terms of the where the unemployment rate would be if you counted all the discouraged and displaced workers. If you went around the country and asked the average person whether or not he or she were unemployed, that's about what you'd get. And that's why Trump got elected. And there are people who miss that basic. I mean, you've had all sorts of crazy polling, but I tell you, the pocketbook issues drive these elections over time, and that's demonstrable. That said, he's also indicated that he's going to do a variety of things to improve the economy, and I'm sure he's going to do his best in that area. He's going to introduce fiscal stimulus, spending, reducing taxes, trying to balance things out with the budget deficit at the same time, which is difficult. The problem he faces is that any kind of fiscal stimulus usually takes about 9 months to work its way into the system. There's a lead time there. So you're going to have a period of time where you're likely going to see some widening of the deficit, even though people will be a little more optimistic. They'll be seeing this stimulus working into the system, and hopefully the economy be picking up some. The problem is the deficit widens, global markets are going to be focusing back on our deficit problem. And there we have a massive one. We're the worst of anyone in the world. We're long-term insolvent. Our net obligations this is now as the federal government, allowing for the net present value of unfunded liabilities for things such as Social Security and Medicare. And I say unfunded liabilities, net present value. The value of that's discounted into the future for the value of money, so that's effectively the amount of money you need to have in hand today to cover these obligations. It's in excess of $100 trillion. That type of money just does not exist. There's no way the United States can ever cover that. And if that's not brought under control, that if the long-term solvency of the United States is not addressed, we're assured of hyperinflation, because down the road the government, in order to meet those obligations, basically has to print the money to pay off the obligations. Otherwise, it reneges on its debt, and in either case, the dollar is going to become worthless, and that gives you hyperinflation. Now, we have another issue which is actually more pressing and more threatening, and that's the Federal Reserve. You go back to 2008 and the financial panic of that time, the banking system effectively collapsed. The Fed, the Treasury, made the decision that they would save the banking system at all costs. I can't say that I would have done differently. We should not have gotten into that position. There are all sorts of bad things that were done by the Fed and legislators that allowed that system to get so out of control. But what they did to resolve the panic, to effectively buy little time, was all stopgap. They bailed out whatever they had to bail out. They created whatever cash they had to create. They guaranteed whatever accounts they had to guarantee. They bought companies like AIG, funded General Motors, Chrysler. What they did was extraordinary, and they bought some time. The problem is that in all those stopgap measures, they did nothing to address the underlying problems that led to the panic. And there were three basic things there. One was the economy, which was crashing and led to some of the other problems, such as the liquidity in the banking system and the long-term solvency issues of the United States. That's where you had weakness in the dollar. And all the things that were done to buy time, bought time, the system's still not solvent. What happened with the economy, I mean, they could have done quite a bit in the way of stimulus. They didn't. The Fed concentrated on saving the banking system. That's its primary function in life. It's not they have a mandate from Congress, yes, to keep the economy growing, to contain inflation, but their primary function is to keep the banking system afloat.
Sure.
All this quantitative easing that we saw basically was aimed at providing solvency to the banking system, to providing liquidity to the banking system. The Fed knew there's very little that it could do to stimulate the economy, but it used the economy or the talk of this quantitative easing as stimulating the economy as political cover for bailing out the banking system. It's that simple. Now, the banking system is it's in many ways better than it was, but it's still not stable. You still have large banks at risk. It's still not lending normally into the flow of commerce. If it were, the economy would be stronger.
So, John, so it seems to me what's happened is, to a great extent, they've redistributed wealth from the savers to the banking system, essentially. I mean, if you push interest rates down and you don't give people anything on their savings, you are giving cost-free money to the banks, essentially. Is that what happened?
Yes, it was.
And so,
not only that, but the Fed bought off the books of the banks bad assets such as mortgage-backed securities. It's all supposedly good, but they did that to give them liquidity so they wouldn't fail. So here's the problem. We now have a Fed that next week is threatening to raise interest rates again. Maybe they will, maybe they won't. They certainly have no credibility, and they talk about, we're lacking credibility, we need to do this. if this is a little boy had been crying wolf, the townspeople would have strung him up by this point in time. It's nonsense because they raise the rates. They're still going to have to come back and provide new quantitative easing. Reason for that is the economy is not recovering. We've seen some very crazy numbers like big gains in retail sales and housing starts. Those numbers aren't going to hold. They're going to reverse out. The employment numbers are just miserable when you look at the underlying reality. And if you look at the headline number, the one that was just recently reported, again, the drop in the unemployment there is not due to people getting jobs. It's because people are leaving the labor force. Well, who's concerned about that? Janet Yellen is. That's the participation rate. It's a measure of the percent of the labor force, which is the total employed and unemployed, against the population. That's at an historic low, effectively. And it got worse in this last reporting. Yeah. The year-to-year change in payroll employment is basically the lowest it's been in a long time, and those numbers are overstated by about 200,000 jobs a month. We're seeing negative growth in payrolls and underlying reality, which today had a trade deficit widening, big one for October, and that signals a widening of the trade deficit for fourth quarter, which means the fourth quarter GDP is going to be a lot worse than expected. Look at industrial production; it's still in recession. The headline industrial production had 1 month of recovery. The official number, that was in November of 2014, popped above the pre-recession high. It's been heading down ever since. That industrial production showing a new recession. 15 months year-to-year contraction, 4 quarters straight of year-to-year contraction. That's never happened outside of a recession. And that's that series going back to 1918. You look at the housing industry. Any number that you look at is minimally 20 to 50% below where it was at its pre-recession peak before the recession. There's just no way that you look at all the underlying detail, and guess what? The headline GDP right now is 13.5% above its pre-recession high. I challenge you to find anything else that's doing that. I mean, this is composed of all these other numbers like industrial production, retail sales.
And John, you just mentioned that the housing market, how weak it's been, and that's despite the fact that we've had a manipulatedly, an interest rate, a mortgage rate that is false, that it's phony. There's no price discovery in the interest rate, in the debt markets now. So I want to ask you something, John, with respect to the rising interest rates. We've seen a dramatic increase in the T-bond rate. Do you think that? I mean, it seems to me, and I'm of the opinion, and I would like to know what you think, that the markets, the bond vigilantes, are starting to waken, and they're starting to see the potential for what you've been talking about all along. That is this massive indebtedness, and that it's not so much the Fed that's raising rates as it is the market that's forcing the Fed to recognize that reality. Any thoughts on that?
Well, you're correct. It is the market that's raising the rates, and they're seeing higher inflation. We're going to get CPI next week for the month of November. That's likely on a year-to-year basis going to be up around 2%, which is the highest level since oil prices collapsed in 2014. That's add 3 percentage points on that, and you've got 5% 30-year bond. That would be the standard, the standard formula.
Yeah, what happens if we get a 5% 30-year bond, John? The markets now.
Well, right now the question is going forward here. If you get the funding again, we come back to the long-term solvency issues because here's where there are two ways, and they're likely going to have some kind of a co-joining of the problems here that will give us a rapid upturn in inflation. One is the Fed having to move back into quantitative easing, to remove these stresses from the banking system that increases the economy gets hit. Weak economy means more stress, financial stress on the banks. the Fed goes back in quantitative easing, and the Fed's backing away from that. Continuously talking about raising rates has been a prop under the dollar. As soon as it goes back to expanded quantitative easing, the dollar's going to take a hit. That's going to spike oil prices. That's going to spike inflation. But you also have the circumstance now with the new administration. They're going to put new sorts of fiscal stimulus in place to boost the economy, and that's needed. You have to have a strong economy to have the system survive, so that's a plus. Again, initially you should have some hit to the budget deficit. It's going to take a year before things start to pick up from the stimulus. And the long-term issues there in terms of the solvency, that's something that Mr. Trump has to address. He's got a creative team. He's beyond the scope of what you've normally seen in Washington thinking. Look at the last 10 years. Nobody could come up with a balanced budget for a year, let alone address $100 trillion long-range deficit in terms of present value. I don't see it happening. We've been living beyond our means for too long, and the system's, I believe, too corrupt. The political interests still are too strong that will prevent it from happening. But maybe something will happen if they can present their stimulus package with a credible long-range solvency plan. Then you have some hope. I don't see the long-range solvency plan coming into place. And what happens if you don't have that? Look back at August of 2011 when Standard & Poor's downgraded the U.S. Treasuries.
Right.
Dollar panicked. Then there's all sorts of interventions, machinations. Same thing's happening here. You're going to have a hit on the dollar from the Fed having to move back into resalvage the banking system, and you're also going to have the hit on the dollar as the global markets not only look at that, but also refocus very specifically on the long-range sovereign solvency issues of the United States. And as that starts to pick up, tremendous amount of dollars outside our system that will be repatriated. Already we're having China's not buying the bonds anymore, and not better. Japan, South Korea. Who's going to buy the bonds? Well, hey, you have the Fed. You go back to the quantitative easing. That was funding the Treasury at that time was also a problem. But what the Fed did in buying up the Treasuries from the banks, as these new Treasuries are issued by the Fed, effectively the Fed monetized 74% of the new Treasury issuance in that period of time. Now, the Fed's still holding $2.5 trillion worth of those Treasury bonds, and guess what? They get paid interest on it by the Treasury, but the Fed refunds the Treasury refunds the interest rates paid, the interest payments to the Treasury. So it's cost-free for the federal government.
All right, John, we're going to have to
get into, and you're already beginning to see the mechanism of near-term debt monetization. We've already had some of it, although they skirted around the inflation issue. The inflation issue is not going to be dodged here because it'll be directly tied to the way the rest of the world perceives the dollar. People dump the dollar. You'll see a panic sell-off in the dollar.
Okay, John, we're going to have to leave it go at that. You said in your recent writing, you said that 2017 will be dollar doom. So I think you've just summed up the reasons, a lot of the reasons. Unfortunately, we're out of time. I'm gathering you're very bullish on gold if the dollar is going to take a hit in 2017. Well, absolutely. Do I have that right?
Physical gold, holding physical. Yeah. That's what, and I prefer sovereign coins because they're liquid, they're portable, and most people accept them without having to assay them.
All right, John, we're going to have to leave it go at that. Unfortunately, we're out of time. So much to think about. We'll have to have you back again sometime so we can go over this stuff in more detail, some of these issues that we didn't get to today. Thank you so much for being with us.